What is going on, traders? Welcome to Celestin Capital. Thank you guys for tuning back into this brand new video. If you're watching, I just want to say thank you because I've been getting a lot of support and a lot of subscribers the past couple of weeks. And if you're new here, welcome to this channel. I'm here to help you guys build a consistently profitable system that suits your lifestyle. All right, whether you want to swing trade or whether you want to scalp or whether you want to intraday trade. The strategy that I'm teaching, the concepts that I teach you guys in the videos that I have posted on my YouTube channel will definitely help you guys achieve what it is you're looking for. All you have to do, to be honest, is just put in the work. Put in the work and sacrifice time. That's all I'm going to ask you guys. Put in the work, sacrifice time, and you'll absolutely get to where you want to be. So this video right here is going to be the final part of the MLBM strategy, which is the final M, and it stands for mitigation. So the first M, I think it's better if I type it out. MLBM. So the first M stands for manipulation. The second M stands for, the first M stands for manipulation. The L stands for liquidation. The B stands for breakout or breakup structure, as it's better known. And the second M stands for mitigation. So let me go over the first three concepts for you guys before I actually go into the final M. And I actually have separate videos posted on these three. Right now, you're going to be watching the final M, which is this one, the mitigation. But I have separate videos on the final three, on the previous three parts of this strategy. And again, if you guys don't know what the MLBM strategy is, I know I repeat it in every video, but sometimes you guys may not have seen the other videos. But MLBM is just a different way of looking at Wyckoff. You guys can watch the video that's titled "You'll Never Look at Wyckoff the Same" after watching this video. If you guys watch that video, you'll understand exactly why I'm trying to show you guys this concept, this newfound concept, this new way of looking at Wyckoff that I discovered. So yeah, without further ado, let me, as I said, explain to you guys what it is. So the first M is manipulation. So we want to see that price is hesitating to go in one direction. We know that perfect structure usually never happens, but when it does, it's very nice. But it looks like this, right? And a lot of times that's not going to be the case. Or if you drop down to a lower time frame, you'll see some kind of manipulation happening within this nice structure. So let's say this is a 4-hour time frame. On a 5-minute time frame, you'll see some kind of manipulation happening. But the overall picture is that it is still a bullish structure in this case, right? So again, if we are on, let's say, a lower time frame, and even just the highest time frame that we trade on, if you're an intraday, say, let's say for me, I'm usually on the 1 hour, and I sometimes go down to 5-minute to 15-minute and 5-minute. But the 1 hour is usually where I find my structure points. So let's say 1 hour price is manipulating. I can look and see what price is trying to do just by looking at structure. So if I see that price is not moving in a given direction, I know that price is manipulating because it's not giving me a clear sign of where it wants to go. So that is what manipulation is. Manipulation is basically price indecision. Price not sure where. Now there's a whole theory behind manipulation that has to do with banks, and there's a reason behind manipulation. But for the sake of this video, keeping this video short and not too long, because I want to focus more on the mitigation, I'm not going to go into detail on what manipulation is. But let's say manipulation is basically an indecision in price. All right. So the L stands for liquidation. What you're going to see is, let's say, support resistance. Some people may see support resistance. People may want to sell at this area, or people may want to buy at support, sell at resistance, buy at support. That's a commonly known thing, right? But what may happen is that price may go one way, stop you out, and go the other way. Or sometimes price might even go one way, stop you out, go the next way, and even stop both sides out of the market. That's what we call liquidation. It's liquidating you out of the market. All right. Break of structure. The B stands for break of structure or breakout. Simple terms. Break of structure. You have a high here, which is broke structure. We have a high here, we broke structure. Or let's say price is on an uptrend. We have a low here, price break structure. And depending on if this is a higher time frame or not, will let us know if price has decided to shift structure, a shift in structure. All right. So now the second M. The second M stands for mitigation. Now I have a video on mitigation. It's called order blocks and mitigation. I think it's one of my most popular videos, but it's called order blocks and mitigation explained. Now, what mitigation is, just to give you a quick recap on that video, basically it costs money to move price, right? So the big boys, which are the big banks, the people with a lot of money, hedge funds, banks, whatever you call it, people with a lot of money move the market. It costs money to move the market. Every single pip that you see the market move, it costs a ton of money to move it in whatever direction it is. It can be up or down. It costs a ton of money to move it in that direction. Now, as I told you guys with support and resistance, a lot of times what you'll see is that price will actually, let's just take this from a smart money perspective. Let's say we have bearish structure, right? Bearish structure. A lot of times what you'll see is that price will, as you see, price broke structure, price came back, price mitigated, which means the banks close out their orders. I'm going to explain a little more in a little bit. And then price continues. A lot of times what you'll see is this, right? And we sell at supply zones in this case. And if this was a bullish structure, we would buy at demand zones. But let's keep it simple. Let's stick to this. We would sell at supply zones, right? So in this case, we'll sell at supply zones. Now, what happens a lot of the time is that price will actually, let's delete this. What price is doing where I just showed you is price is actually mitigating. So, as I told you guys, it costs money to move the market, right? What you'll see a lot of times is banks will push the market up. In this case, we say it's buy to sell. What they're doing is enticing people to buy the market. They're enticing people to buy the market. What they're really trying to do, if you look at the overall structure, is sell it from this supply zone, right? So they're buying it. They're putting money into the market. They're pumping money into the market in order to sell it. So they just sold it. Now, here's what the mitigation is. Price needs to come back. Well, price needs to come back in order for the banks to close out their orders, right? So because the banks push price up, right now they are in a negative. They are in a negative right now. Let's delete this. Let's say right now price is in a negative because the banks push price up trying to get people to buy into the market when their real intention was to sell it. What they have to do is they have to come back up. So they've got some open buys in here. They've still got some buys open up here. Their buy positions from here are still open and they're floating in the negative. But their sell positions are in the positive. So overall, they're in the positive because their sell positions are a lot larger than their buy positions. They bought the market short term in order to sell it long term. So they took all the people's money that was right here. And that just generated even more money for them. So right now, the bank's sell positions are in the positive while their buy positions, their small buy positions, when I say small, it could be millions of dollars for the banks. Their small buy positions are in the negative. What they need to do in order to close this out is they need to come back to this area and close their positions, which is what we call mitigation. So they come back to this area in order to mitigate to continue price down. It's similar to this. Let me show you guys really quickly. Let's say we're looking at some bearish structure, and I have two examples that I'm going to show you guys, but this is just an example I want to show you guys. Let's say price is bearish right now, right? So we're looking to sell the market, or we're looking to sell the market. So price is bearish. We see that price comes down. You see they sold up. They bought it up in order to sell it. Now what has to happen? Price has to eventually come back up so they can close out their positions at break even. Similar to if we were to get into a sell, and let's say we sold the market. Let's say we moved our stop to break even. They would close their positions at break even so that they're no longer in the negative but in the positive. So their buy positions are closed out. The buy positions that were once in the negative from here, as I showed you, the buy positions from here that were in the negative are now closed at break even because they came back to close those orders. And now all they have running is floating profit with the sell positions. That is what mitigation is, guys. It's as simple as that. I hope I made it simple enough for you guys to understand. If I didn't, leave a comment down below. But I'm going to show you guys the two examples that I have prepared for you. So again, mitigation is what is the name of the game that we're talking about in this video. Mitigation is very important. If you can understand it, you can absolutely become a profitable trader. So let's see. So in the sell scenario right here, actually, let me do the buy scenario first because it's a lot simpler. It's a lot cleaner. So we see price came, price liquidated this low. Price liquidated this low. So we see some kind of manipulation. That's the first M. We see a liquidation. Price liquidated this low. It's a liquidation because it didn't close below the low. Liquidated the low and then shot up. We see this huge break of structure. Break of structure. That's the B. So we got the manipulation, we got the liquidation, and then the break of structure, this huge impulse. You see these candles right here? These candles, huge impulse candles that broke structure to the upside. Now, what can we expect? Because the banks are in the negative right now on their sell positions, because they sold in order to buy the market, which is their long-term goal, as you see, buying the market. What they have to do is they have to come back at some point to this demand zone to close out their positions. So they sold the market in order to buy it. Now they're floating in the negative on their sell positions. Now what did they do? They came back, closed out the positions in order to continue buys. Now their sells at break even and their buys are in huge profits. I hope that makes sense for you guys. All right. So mitigation, this is what we call the mitigation. Banks closing their orders at break even. Let me show you guys the sell side example that I have marked up for you. So this one is going to take you, it's going to take some time to understand this one because this is based on candle structure, not really market structure. As you see, you get the liquidation of the high. The high gets liquidated. Now, where's the low? The low is right here. This low gets broken right over here with this candle right here, this impulse candle down. Now, what I like to do is I like to get in on the mitigation of the low. So once price breaks the low and it comes back into that zone, you can get in. Now, if you want, you can refine it more to some kind of imbalance. But what I like to do is if the stop loss is small enough, if the RR is good enough, I like to get in right after price taps back into our zone. So once price breaks the low and it taps back into the break, I want to get in. And as you see, the market bought up in order to sell. And what happened? They came back to close their orders at break even to continue selling the market. It's as simple as that. Now, it's going to take a lot of studying. It's going to take a lot of collecting data in order to understand this, in order to understand what I'm talking about. And I've simplified this a lot. There's a lot of theory behind what I just talked about. And if you guys want to hear the theory, watch the theory video. It's called Order Blocks and Mitigation Explained, something like that. It's one of my older videos. So you guys can check that out on my channel. I hope this made sense for you guys. And yeah, the proof is in the pudding, guys. You go ahead and backtest this yourself. That's the thing. You have to go and backtest this yourself. You can't just hop into the live markets and think that this is going to work. And then you guys are going to call me a scammer, which is not the case. I'm just trying to teach you guys. I'm not charging you anything. This is free content that I'm trying to teach you, free education that I'm giving you guys. All you have to do is backtest it and get the reps in. Same thing as when you're practicing for any kind of sports. You have to get the repetitions in. Trading is no different. You have to get the repetitions, repetition after repetition after repetition. It's as simple as that. And once the repetition becomes a habit, it becomes second nature. So I hope you guys enjoyed this video. If you did, hit the like button. And if you guys don't really understand it, leave a comment down below. And if you guys have any critiques, anything, let me know down below. I will see you guys in the next one.